Hello, everybody. Thank you for joining us today. We're going to get started with the webinar in just a few minutes. But first, we wanted to make some general announcements and introductions. My name is Ari Kornhaber, and I'll be your moderator for this webinar session. Today, we will be covering case flow versus cash flow. Too much or not enough? We are honored to have our guest speakers today, including Seth Price of Price Benowitz and Brian Koshers of Koshers and Company, CPAs. Seth Price is a founding partner of Price Benowitz LLP and the firm's business backbone. Seth is committed to a firm that provides excellent representation and exceptional customer service, a business formula that has seen Price Benowitz grow from 2 attorneys to now more than 40. A transformational leader, Seth is often asked to speak on law firm development and legal marketing strategy. And it's nice that the tables have turned because Seth has been a moderator for me presenting at times at conferences. So it's nice to be on the other end of the dais with you, Seth. Thanks for joining us.
Thanks for having me.
Brian Koshers is a CPA and focuses his business on small and mid-sized companies, closely held service businesses with a special focus on professional service firms, including law firms, dentists, doctors, as well as real estate firms. With more than 25 years in public accounting experience, Brian oversees all aspects of his clients' tax planning and day-to-day business management planning, including startups, practice analytics, and corporate budgeting. Brian, I know you a long time, and it's really great to have you here. Thank you so much for agreeing to participate today.
Thank you, I appreciate it.
I want to begin with Seth Price. Seth, great to see you. Maybe you could just help us frame the conversation, right? You're a business owner of more than one business, and your firm has seen explosive growth, your law firm. If you could take us back to sort of the genesis of your law firm and how that has evolved to its current state and the other sort of side hustle that you like to say you're involved in.
Yeah, no. So thanks for having me. Great to see you. We first met splitting a cab back at a conference, and who knew that a decade later we'll be sitting here chatting away. But for me, it's a passion play. I started the law firm with a law school college buddy, and we started as a criminal boutique. And so cash flow was never really an issue. We sign up cases starting, with lower dollar blue collar and over the years up to white collar cases. But that was sort of the origin of the firm. We pivoted into plaintiff's work, and there's that oh shit moment when you're like, there's a lot of money going out the door and being put on the street. I now have the benefit through Blue Shark, sort of a side hustle that's turned into a viable business, which is sees inside of dozens, if not hundreds, of plaintiffs firms around the country. And these are similar questions, whether it's talking to clients or masterminds. The issue of balancing cash flow for a plaintiff's practice, obviously, something that is constantly on the mind of practitioners, particularly in the early years. And as people build and grow, we didn't feel the pinch at first with sort of steady cash flow from criminal, but as your plaintiff's practice grows, it's definitely been something that has, really been something we focused on a lot.
Yeah, it's interesting, case flow, cash flow. It's such a capital intensive business. And as you know, the audience may not, I was a practicing plaintiff's personal injury and mass tort trial lawyer. So I've experienced those issues firsthand as a practicing attorney, and now seeing it from the financial service provider perspective, very interesting. And Brian, when we talk about cash flow, there are multiple sort of views of a law firm's cash flow, and you have a pretty interesting lens to look through. I'd like to start with a discussion on PPP. A number of registrants asked a couple of questions about PPP. As we know, it's still going on for another couple of weeks, this round 2. Maybe you could start by talking about some of the differences between round 1 and round 2 for those firms who maybe either sat out round 1 or participated in round 1, aren't sure what to do in round 2, forgiveness, things like that.
Sure. So, PPP started in a manner where it was all over the map. It was going to be a loan. It was going to be income. It was going to be it changed by the week and so on and so forth. And then finally, it adapted to this fantastic program where it becomes not income. The expenses relating to what the money was used for are allowed to be deductible expenses, and it contributes to basis for the owners. So it's become this fantastic program that people, if they qualify, they should take advantage of it for sure. PPP2 is going on now, and as you mentioned, is couple of weeks away from closing, but try to take advantage of that as well. That has a little bit more restrictions on it in the fact that you need to have under 300 employees. You need to have a reduction of income for 2020 from 2019 from the same comparable quarter by over 25%. You need to sort of state that you use the money in PPP1 for the right purposes. One of the big issues that we're faced with some of our law firms is mentioning about the necessity test. And even though in the beginning stages, it was stated that only borrowers over $2 million qualified for the necessity test, but we're asking our law firms to potentially document the need for these dollars, even if though they did better in, let's say, 2020 versus 2019, their case intake was down, their trials were down. Here in New York, there was 60 judges that were laid off who specifically see these cases. So documenting these things in case necessity ever comes into question wouldn't be a terrible thing to do, even though it may not be asked today.
So you mentioned a couple of things that I think are worth expanding on, or at least pointing out, because I know from being a PPP provider, Esquire Bank, we've been entrenched in this since it launched in round one. Number one, the program, round two, was extended to March 31st, 2021. So this round two is more of a marathon as compared to round one, which we all know was a sprint, right? It was first come, first serve. The first tranche ran out. There was a second tranche, and there's actually still $138 billion of unspent loans from round one included in the $248 billion, which was allocated for round two. So again, you have until March 31st or until the funds run out. So there's still time to participate. Even if you didn't participate in round one, you can in round two. That would be called, if you did in round one, it'd be a second draw loan. You mentioned that the PPP
and something to clarify, Ari. There was pretty big legislation recently. We were talking before we went on. I'd love Brian to talk about what that meant. This could have been a real tax disaster for people, and we've just gotten some clarity over that. And I feel like that's pretty important for Brian to talk about.
Sure, I think.
Brian.
Sure. Well, yeah. What Seth's referring to is that prior to the last week of 2020. The PPP money was going to be considered as a reduction of the expenses used to justify the PPP loan. It wouldn't be treated as loan forgiveness, but in essence, it would be sort of income. If the expenses were deductible expenses and no longer now allowed to be deducted, it's in sheep's clothing income. So in the last week of the year, they converted that and said that the expenses could be deductible. The loan forgiveness would not be forgiveness of debt. And like I said before, which sort of is a little overlooked, but pretty important concept, is that it contributes to basis. So that change was massive for business owners, for sure. I think that's pretty much what Seth's referring to in that one.
Said another way, forgiven PPP loans are not taxable, and forgiven expenses are tax deductible. There was that needed to be clarified in round two, and it was. And to Seth's point, huge, both of your points for the business owners.
Right. It was until recently, and it was kind of, for those of us that had first round PPP, there was this moment where you were like, you had spent money based on the original rules. The rules had elongated the number of weeks you had to spend it, so you spent it maybe not the way you would have had you known you had that extra time, and all of a sudden you couldn't deduct things against it. I was speaking to my Brian, trying to say, hey, what's plan B? How much do we have to escrow in case Congress doesn't come together and make that happen? So big relief to see that. And for those taking round two, a nice relief to know going in what they're facing, whether the positive piece.
Yeah, another good point you brought up. In round two, the borrowers are allowed to choose a covered period that is any period of time between 8 and 24 weeks. So that's an important distinction. Brian, you mentioned the 25% reduction in revenue. That could be year over year, right? 20 compared to 19, or the same quarter within those 2 years. Is that right?
That's absolutely right. In addition, is that if a business started up in the year of 2019, the fourth quarter could be used to compare against any quarter in 2020. So it doesn't only have to be a business that was down in, logically, let's say Q2. It could be and have a comparable quarter to second quarter 2019. It could compare, if it's a new business, to Q4 2019. So a little bit extra tweak as well.
Right.
Right. And knowing that you have those weeks up front, there was a lot of permutations about how much to spend on rent versus salaries. Pretty much 24 weeks, there's much less pressure on the entrepreneur to figure out how to allocate it, that it will most likely work no matter what, with that much time to work with.
Right. With all the changes, all of 2020 was 12 months of tax season for me.
I guess two last points on PPP and we'll move on. One is PPE, right? That protective equipment is now included as an eligible expense for the owners of businesses and firms who used some of the PPP loans to protect their employees. And there was a question that was asked, if you went to Bank A for a PPP loan in round 2, do you have to go back to them for round 2? If you went there for round 1, the answer is no. You can go to a different PPP provider if you would like. So the point is, the PPP loans, obviously, if used right, they're forgiven. What a great opportunity for those with a short-term business need. I want to take a moment now and think about the long game, because contingency fee attorneys really have to think about the long game. And the long game got longer. Stay-at-home orders, court closures, no threat of jury trials. The cases are still as valuable as they were pre-pandemic, but the durations have been extended. That's going to create cash flow issues. The stay-at-home orders meant intakes were down for many firms. A lot of firms have yet to feel the impact of that because of how long cases take to evolve until they're ripe enough to mature and resolve.
There's another element which you said everything that's true. I would say dig even deeper, that when we first started, especially sort of single event auto firms weren't feeling it as badly because stuff was still settling. What I'm seeing across the country, especially Blue Shark clients, sort of feedback is that the larger stuff is not settling unless there's a bad faith that's pushing it along in like a state like Florida. That what we're seeing is people, they're holding out, and then you have both clients and firms getting squeezed, and insurance companies know that. So that I'm concerned not only is it going to be elongated in time, but you also may see less revenue at the end of the day.
You make a great point. I believe every contingency fee attorney recognizes that compared to other businesses, their cash flow is irregular, and there are ebbs and flows and peaks and valleys. And for firms that handle catastrophic personal injury and medical malpractice cases that typically prepare their cases for trial and either try them or resolve them on the doorsteps of trial, those peaks and valleys are going to remain and get steeper.
Right.
So,
I would say the places like, for instance, New York, where it's commonplace to have to get yourself to the courthouse steps, and that where you're not forced to the courthouse steps at the moment, that those are places, and the catastrophic lawyers are the ones that are sort of most concerned at the moment as far as the longevity and how long they're going to have to hold out to get back to some form of normalcy.
Absolutely right. In states like New York, where you have to put basically every case into suit and go through that 3-year process in a normal time, that process has gotten longer. And when the courts open up, they say that the criminal cases will go first, then the civil cases. So we'll see what happens. So, Brian, as somebody who is turned to for financial advice, what are some of the things you're telling your law firm clients in terms of preparing for this long game, this interruption of cash flow? There are so many issues that we're going to touch on. Generally speaking, where do you start?
Borrowing needs to be sort of part of the philosophy here. We talk about a lumpy cash flow cycle, and that's no truer than contingency fee attorneys. Something to consider may be bringing in a singles and doubles hitting type business included in your routine. The big home run hitting, big case. Part of your firm is one piece, but also having a little bit more of a singles and doubles business. People turn to real estate closings or whatever it may be. Just something to come in that can bring cash flow to a firm on a monthly, weekly basis that can help with the easy overhead. Businesses who are talking about what we're saying here on the long game, maybe consider making adjustments to overhead. Maybe staying as lean and mean and while you're in growth mode as much as you possibly can within reason is an important way to go about it. But yes, certainly borrowing is a very big and important part of this conversation and needs to be incorporated in all contingency law firms for sure.
Yeah, and that's a trend that we're seeing from the financial service provider perspective. More and more law firms that were traditionally what we call self-financed are now becoming more educated on their financing alternatives. And many of them are at least starting to apply for just a working capital line of credit to have as dry powder in case they need it for those short-term business needs, to your point, for rent, overhead, payroll, etc. I think we have to turn our conversation, it was part of the polling question, to case costs. And how they're treated and what law firms can do, because they have a very unique opportunity when it comes to paying for their case costs, which obviously they need to incur. Maybe we could start, Brian, with you and talking about phantom income. Okay, it's a phrase that is thrown around quite a bit, and quite frankly, I don't know if everyone on this webinar truly understands what phantom income is. Maybe you could help us start with what is phantom income, and then we could go from there.
Sure. Phantom income is a term that's not industry specific, but generally it's defined as when a business owner has taxable income, but the money used to generate that taxable income has gone, and therefore the tax bill comes, and the money to help pay that tax bill has been spent on something else. So in this situation, it would be spent on case costs. So when a contingency fee lawyer has case costs that are recoverable, or in essence, in theory, recoverable, and the resolution of these cases, are expected to be more than a year, those aren't deductible expenses. Those are considered loans or receivables and can't be deducted as expended. So several firms, many firms, and unfortunately this is widely overlooked, use this philosophy of self-funding. They take their legal fees and they spend those dollars on case costs, and they took $100 in, they spend $100 out, and they think the world's a good place. And unfortunately, that's just not the case. So, in that situation, we want to make sure that, clients understand that this self-funding philosophy could generate, if treated properly, could generate this phantom income. That's sort of a disaster in our industry.
I have to stop you there, because as a financial service provider and a lender to the legal community, we see a lot of financial statements. And it's really amazing how many, probably half or more, show that law firms are treating their case costs as expenses and then declaring income when cases resolve and they get their funds back. Now, you're saying that is wrong, right?
Correct. That's not an accurate way of, right. That's against the rules for sure.
Now, when you say it's against the rules, is it against IRS rules?
Yes, it's against the IRS regulations. You cannot deduct case costs that are recoverable when the resolution is expected to be more than a year. You cannot deduct those expenses. You can deduct operating expenses that support your law firm, but you can't deduct specific case cost expenses relating to those cases.
Very interesting. How do you explain so many law firms doing this wrong?
Lack of knowledge in the specific tax laws that go about in their industry. I think that it is a very difficult method it's a difficult piece of this type of business, meaning that you feel in logic, I took in $100 of income. I spent $100 of expenses. Those expenses help support my income. It's matched okay. If I don't succeed, no problem. And it's a little bit sort of out of sight, out of mind. So
and what's most painful about that is it's post-tax dollars that you're putting in that are not even deductible.
for sure.
So Seth, I was going to ask you, I mean, you've gone through this, right? Maybe you could talk about
There was a
pros and
life
cons.
moment when the accountant sat us down and said, "Yeah, this is not intuitive, but this is the way it is." It is definitely one of those things that makes the plaintiff's practice that much more, interesting and things that you have to plan for, because it is something that is not intuitive. You would think it would be deductible, it's just not, and that's where we work with our Brian to try to make sure that we maximize what we can, and knowing that there are options like Esquire out there, in order to smooth that out. It's an important thing. And as you're saying, if you see the inside of a lot of financial statements, you're saying more than 50% aren't doing it right potentially. That's not nothing.
Right.
Yeah, I think it's important, Brian, you and I have talked about this offline, of working with somebody who has experience in your field, not a generalist, but someone who has specific knowledge and experience in the field, whether it's a CPA, a financial planner, et cetera. And Seth, you talk about planning, right? And it's become so important. And so many lawyers have financial planning in their personal life, but not as much financial planning when it comes to their business. Seth, maybe you could talk about the daily balancing act that you go through as a manager of a law firm, where you have to dedicate financial resources to running your business, to growing your business, and to financing your cases. How do you pick and choose?
No, and like one of my mentors, when I came into the market, one of the big players in Baltimore, he showed me when I was starting out what he called on the street. And it, at the time I could never imagine doing that. And now several years later, I'm looking there, I'm like, that's a lot of money that's not sitting in my bank account, that's sitting out there. What a lot of lawyers struggle with, and I think that is whether or not passing along the interest to the clients. That's something that some people have no problem with, and to date we have not done. But it is something that if you do, it makes it a lot less complicated of an equation.
Let's turn to that specific opportunity. Brian, you're aware that contingency fee lawyers have the opportunity to finance their case costs, right?
Correct.
Could you talk about that and what you've seen from firms who have done that?
To finance their case costs, sure.
Yeah.
That is the way that this industry, or lawyers in this industry, law firms in industry, grow their firm. It's difficult to avoid financing. If we're talking about this phantom income problem before, it's difficult to avoid the financing. Case costs are the lifeblood of the industry. So if you're selective and you're intelligent about where you're spending your money and putting those dollars on the street, as Seth mentioned, that's the way that we grow in this industry. The interest relating to those loans is deductible. And Seth mentions about passing along the interest potentially to the clients. That's something that some firms take part in that, some firms don't. But we've always suggested to our clients, put in your retainer agreement, so at least you have the option to do so. If you decide to change your tune later on and then it's not in your retainer agreements, then you have to wait 3 years before you get into the next group of settlements, let's say.
So I see how it all sort of plays into each other. It goes hand in hand, right? You have this capital intensive business being a contingency fee law firm. If you're following the tax code, then you're exposing yourself to this phantom income if you're self-financed. So now you start thinking about, like you said, the advice that you're giving is explore the alternatives with financing. And that could be to run your business and a separate credit facility to finance your disbursements, which gives the borrower, the law firm, the option to either write off the interest as an expense, or if there's specific language in their retainer agreements, they could treat the interest as a case cost itself and pass it through to their client. Either way, correct me if I'm wrong, from a tax perspective, by financing your disbursements, you're somewhat addressing that phantom income issue that contingency fee attorneys face.
100% you are. 100%.
Right. And as a marketer, one of those things that you struggle with is you're always trying to figure out how can you maximize dollars out to bring those cases in to keep the firm building and growing. And so that when the money is on the street, that's money that's not going towards getting more cases in the door. So it's definitely a pull and tug for many firms.
Ryan, what's your advice to lawyers who are asked to personally guarantee one of these credit facilities, whether it's a working capital line of credit or a separate line of credit for case costs? If a lawyer came to you and asked for your advice and said, it makes all the business sense in the world, but the lender's asking me to personally guarantee this, and I don't like the way that feels, what would you advise?
That doesn't bother me. I always tell my clients that they need to and should bet on themselves. If you feel comfortable, with the case costs that you're expending, and you feel comfortable that your firm can maximize in your settlements and your trials and your cases and all that other fun stuff, personal guarantees don't bother me whatsoever.
Seth, what's your feeling on that as a lawyer?
Mixed feelings, and I think we've talked about this offline. It's one of those deals where, I don't love it, but I understand Brian's point. And that, if it is something that will allow you to build and grow your firm, then it may be that I have the benefit of some cash. I may be not using it wisely, but I have that cash to make that decision. But if you're going with a completely contingent firm, unless you're independently wealthy, you're not going to be, where do you get that money to put on the street? You're going to need something. And so, then you're left with the decision of, do you want Esquire rates or do you want hard money rates? Which, when you lose the personal guarantee, I assume that the rate difference can be 12% or more.
Yeah, correct.
For sure.
Excellent. Well,
you have to also look at it from the bank's angle as well. Sorry, you have to look at it from the bank's angle as well. Is that personal service businesses are thinly capitalized. What are the assets of the business? Selling the computers and selling the desks and the tables and the pens and pencils don't yield much fruit. So, what else is there? And many banks don't, unfortunately. Some do, but many banks don't consider case costs and unsettled case inventory as an asset or a collateralized asset at all. So what else is a bank going to look for? So, we of course, we work for our clients, and we want to make sure that we're doing the best thing for our clients, but we have to look at it from both angles as well. The bank has no other source of repayment if they can't touch the cases and there's nothing in the firm to grab.
Right. And I guess one of the things I've loved about Esquire and what you've professed from day one is, like, by understanding the business and being founded with lawyers, I mean, you get it. Whereas even if you're willing to put a personal guarantee and you walk into the average bank, you may or may not get somebody that understands what you're doing and how this is going, and you're just hitting your head against the wall. So that at least if you are willing to go that route, knowing that there's a place that gets the value of those cases, is not nothing, because dealing with bankers outside of their real estate widget, which is what most of them deal in, is something that is very foreign and can just spin wheels and not get you your money.
It's interesting. One of the participants asked it, and to your point, how do you get a bank to treat a personal injury case as an asset for purposes of collateral? I know I could answer it because we've done it, but I don't know others who have. And it's
right. I will say one thing. I've met with, I don't know, a dozen different bankers at all different levels and so on and so forth. And outside of a few banks, they don't necessarily treat unsettled cases as collateral. But there is a little bit of a softening out there in the fact that some banks are starting to invest in, let's say, pre-settlement funding businesses and so on and so forth, different asset classes. So maybe there's a day where banks will treat this a little bit more like conventional banking, but unfortunately, it's not mainstream today.
Sort of to put a bow on this topic, you're right. When you look at the balance sheet of a law firm, they pull everything out at the end of every year. So the PG becomes important for the lenders to know that the borrower has some skin in the game. But Brian, explain the difference between a personal guarantee and actually pledging personal collateral like a brokerage account to support a loan.
Sure. A personal guarantee is a signed document that basically says, God forbid the day ever comes where there's a default, the bank has the opportunity to go after personal assets and needs to sort of create a lawsuit to do so, in essence. Pledging is a little bit harsher, a little bit different, where you are taking assets. It can be at the specific bank, it could be at a different institution. And those dollars you can buy and trade and sell and whatever it is, but it can't fall outside of that box. So if it's in brokerage house XYZ in the name of firm XYZ, and it's in that account, it needs to stay in that account. If the dollars fall below, then the pledging could be called and issues could come to be. But it's specifically taking assets and saying those are assets where I'm going to use as hard collateral in case there's a default and grab those first.
All right, I got an ignorant question because I just don't know how Esquire does it. Does Esquire allow for deposits to sort of be the collateral, or are personal guarantees required? If you had enough assets under management, is that something that can allow you that line for expenses?
We do not ask for personal assets to be pledged as collateral. We do treat the work in progress, the future potential fees, to serve as the collateral for our lines of credit, but we do ask for the borrowers to provide a personal guarantee. So
for non-Esquire borrowers, though, they should try as best as they can to make a case for themselves. Show the history of the firm, show the success of the firm, show the growth mode and how long it's been and how much you've done. Showcase inventory and the pipeline and where the cases are in the pipeline, and explain to somebody who may not necessarily know your field as well, where they are. If we're 3 years into a case, why is it like that? And how come we could be really close to seeing dollars and so on and so forth? I think that's got value. It may not be 100% successful every time, but I do think it adds value.
It absolutely does. We recommend that all the time, that lawyers and law firms should be preparing some financial projections based on their inventory, even if it's just by year. What are they projecting to generate in revenue in the next 12 months 13 to 24 and 24 to 36, and revisit that quarterly. And if you show that information along with your financial historical information, you put that together and like you said, you're making a strong case for yourself. And again, PGs are often asked for. It's something that can be negotiated depending on the strength of your inventory, your financial history, etc.
Is that the amount of the guarantee, or is that whether there's a guarantee at all?
It's whether there's a guarantee at all.
Gotcha. If the numbers are if the loan to value is so great that you would, in those instances, a strong enough firm, they might not need it if in fact it was crazy valuation.
There are a number of variables that go into the equation, including how many partners there are. Is there a succession plan? Does the firm keep any equity in the firm, etc.? And every bank does it a little differently, and especially finance companies look at this differently. At the end of the day, liquidity is very important right now, right? We're going to start talking about the changes in the tax laws that are coming. And we already talked about how case durations have extended. More and more law firms are exploring and becoming educated on their financing alternatives. So the more organized your house is, the better options that will be presented to you, right? So, Brian, you said to me offline.
Before you jump to the next thing, you have to remember is that on a personal guarantee, we're looking at it only from a negative angle. But if a business happens to be set up as, let's say, a partnership, and you are personally guaranteeing the loan, and you have a very thinly capitalized business, and partners, let's say, it happens in a year, distribute more money than their equity, then personal guarantees do add value because it creates something called basis, and it doesn't generate taxable income. So, personal guarantees are certainly have a negative connotation and scared about them, so on and so forth. But there is a little bit of a decent play if you're a partnership that creates basis, which has some value as well.
Excellent. All right. Yeah, look, the clock is moving quickly, and a number of lawyers asked questions about what should they be doing, what should they be thinking about with the Biden administration in power. And Brian,
that's my question. Like, what? I know nobody has a crystal ball, but what should we expect? That's what most lawyers are talking about. We in one sense, we got treated badly under Trump. In some respects, certain respects, tax laws were favorable. Brian? What do you think? What do we see over the next 4 years? Just for most people, we're cheering the Biden arrival. At the same time, it's not going to be good from a tax point of view, presumably.
No, taxes are not going to be fantastic at all, to say the very least. But before we even go there, I just want to mention one thing about what Biden is pushing, and that's worker classification. So many law firms classify properly or improperly, employees as W-2 versus 1099s, and that's something that should be looked at very carefully. We're trying to explain to our clients that paying individuals 1099 is a little bit taboo, and maybe having those individuals, form entities and getting invoiced from those entities may be a better way of going about things, because that worker classification is becoming it's been a hot topic, but it's going to even be more of a hot topic. On the tax side, yeah, it's the topic of conversation in almost everything that we do, because everybody is so nervous. The difficulty is that it's very unclear. We don't know exactly which of the proposals will come into play. We definitely don't know the timing. When Trump came into power, he waited a full year before he made any changes of any major magnitude from taxes. The one thing that we do know for sure is that anybody who's earning $400,000 or more, those people are going to experience some significant pain as far as tax rates. Tax rates will go back up to 40%. They're losing, once you hit $400,000, most likely Social Security will start back up again. That's a little bit of a scary conversation. Estate planning changes are going to be made. Gifting, capital gains won't exist. Capital gains tax rate won't exist if you're making more than $1 million. Itemized deductions will be adjusted immensely. There's just so many different things that are coming down the pike. So law firms should consider possibility of changing and adjusting their entity, different compensation structures, income deferral methods, things of that nature.
I just got that email from our account. Time to start thinking about entity structure. One of the things under Trump, shockingly, non-lawyer, closely held family businesses did really well under the tax laws, and law firms, lawyers in particular, did not get favored. Do you foresee some of that inequity that was sort of structured around the Trump family business getting undone that would possibly benefit lawyers in the sense that lawyers were in Trump's crosshairs?
I think this is going to be a dollars only conversation. So, it's not going to be geographic. That's one thing that different people in different areas of the country complain about a lot. I think this is purely going to be dollars and cents, and I don't think it's going to be industry specific. Trump seemed like he had a sort of an agenda with certain things where real estate were benefiting and what have you. But I think it's purely about money. If you make over $400,000, you're going to experience some pain here. And I don't know necessarily. I don't know necessarily if whomever was elected, would change significantly, because so much money is being spent on coronavirus. That I don't know necessarily how the government recovers from that other than raising taxes. I just don't see that, changing whomever was elected.
So a couple of follow-up questions. You're talking about changing the entity as one possible way of pivoting and adjusting. Can you expand on that?
Sure. Most law firms tend to be either partnerships or PCs or S corporations. So could it be worth it to consider becoming a C corporation? Could it be worth it to changing from a partnership structure to a corporate type structure, when some of the income you earned could be corporate distributions and not subject to self-employment tax? Things of that nature. So if the Social Security tax comes back after $400,000, and a person is making $1 million, right? Then from $400,001 up to $1 million, they were previously not paying Social Security tax, and now they will. So that's $600,000 times 12.4%. That's a lot of money. That's 70 grand. That's a lot of money. Just the flick of just at a quick moment's change. That's one of the things that we're experiencing and trying to see if we can adjust it. But because we don't know, it's hard to give this kind of advice with any clarity. It's
Did you
too
do any
difficult.
modeling based, like we knew what Biden was campaigning on, right? Increasing the corporate tax rate, the income tax rate to 28% from its current rate of 21%, and the return top individual tax rate to 39.6%. So knowing that he campaigned on that, could you model some of these issues out for law firms to help them make these decisions?
You could, for sure, if you knew what the game plan was and the rules that you were working with. So we don't know what the rules that we're working with just yet. So we could model it 62 ways till Sunday, but the problem is that we just don't know the playbook yet. So it's difficult to do, unfortunately. I don't mean to duck the question, but it's difficult to do when we don't know the rules.
Understandable. What about, we talked about, let's say a law firm is, renting their office space, and as a result of COVID, their commercial office space needs have changed, and there's an opportunity to maybe purchase something and obtain rental income. Is that an idea that you think could make sense for some businesses out there?
I love the idea of investing in your business, investing in other businesses. The traditional conversations about deferring income are retirement plannings and deferred compensation and structures and things of that nature. That's the traditional way. But you can look at deferring income in a different manner. You could look at it by opening up another business, investing more in your own business. Like I said before, bet on yourself. Should I buy more space? Should I get better technology? Should I better equipment, better staff? A marketing campaign. If I'm spending more dollars now, reducing my income so that I have more income down the line when tax rates are a little bit more beneficial, that seems like a good strategy to me.
That seems to make sense. I see that there's a polling question about deferring attorney's fees and revenue. Seth, do you have any experience in structuring attorney's fees, maybe the traditional way? I know there are a lot of new products out there as well. What's your experience?
We've experimented, and I've seen colleagues around the country doing all sorts of structured settlements, both for clients and different tax savings for themselves. For those of us in growth mode, we've sort of put more money back into the business. But I've seen a lot of legacy firms or people that are sort of thinking about retirement in the nearer term, doing some really creative, interesting things to basically put away more money from a settlement that doesn't necessarily get taken with these, what may become really substantial tax increases.
So Brian, back to you. We have experience with this. We know that attorneys can structure their fees pursuant to Childs versus Commissioner, that 11th Circuit ruling. Have you spoken to any of your lawyer clients about structuring their attorney's fees through those traditional products or some of the newer ones?
Sure. Structuring is always part of the conversation. I'm a fan, although recently, with interest rates being low, the structures yield have not been as exciting. But with tax rates going, what I feel to be through the roof, maybe it's worth taking another look at that. Also with law firms, a retirement plan is a great strategy. But if you're really trying to benefit the owners, a real robust retirement plan is not so easy to do. So if we can consider these structures as like a fake retirement plan and we can discriminate, then it's certainly worth something to look into. The other thing also is that, it doesn't have to be structuring a $150 million fee. Structure a small fee. Dip your toe in the water and see if it's something that you can understand, that you can enjoy. Structure it out so that it doesn't go maybe 30 years or 20 years or something like that. Structure it out so it's a shorter span. Just get some education, because there is special wording that needs to be done in the settlement statements that is important for the structures. So I keep on encouraging my clients, and I always will, to sort of dabble in different asset classes. We don't have to be a one-trick pony and just invest in Apple, and that's all we're going to do. So, I like these structures. I do. I think it's part of an overall plan.
And I like how, again, this all plays together as we're talking about this capital intensive business, phantom income, raising taxes, and preparing for that. If we just saw the polling question, the majority of the responders said they have not structured a fee in the past because they need that cash flow and revenue to run their business. So now you start talking about what we were discussing earlier. Well, if you're a self-financed law firm, you're paying for case costs with your own money, so you're not structuring your fees and taking advantage of that because you need those fees to pay for disbursements. If you took advantage of the opportunity and started financing your disbursements, your business would be more liquid, giving you the ability to maybe consider structuring a small part of a fee to get comfortable with those products as well, and seeing how they do for you.
Sure.
So Seth, I want to go back to you. Maybe you could share with us some actionable insights that other law firms can use and apply to their businesses to help set their law firm apart from the competition. And again, understanding the environment that we're in.
Well, I mean, each firm is different at different places. I think that, as Brian just mentioned, educating yourself as to what the options are. What are the lines that are available? What are the decisions you have to make as to whether or not to pass that along? What structures are out there? Like everything, knowledge is power. And if you are able to do that, I mean, many people who are on this call know a lot of these guys well. Howard and others that are listening, that a lot of us have rolled the money we've made back into the firm and have not taken advantage of many of these structures because we want to be able to sort of build for a bigger tomorrow. But the question is, taking Brian's advice, is it possible you want to sort of take a settlement here or two and structure it out? These are things that I think that it is overwhelming, and I always find whatever it is, whether it's structured or whether it's malpractice insurance or whatever, you almost have to become a mini expert in it overnight. Any good litigator sort of can become an expert, and so I feel like it just getting to know industry people that have been around for a while. If you keep showing your face over the years, presumably you're a decent repeat player. And those are the, sort of just through that and speaking to peers about what's worked for them and what hasn't, I think it's really valuable networking.
Interesting. All right, let's go to the chat box because a couple of questions have come in. One, how do firms show a strong pipeline? And how is the firm acquiring new cases? Do you look at their advertising budget? Seth, this is probably, well, for all three of us, I'll start with the strong pipeline because this is what we look at, every day. Again, when we lend money to a law firm, we're using their case inventory as collateral. We suggest that law firms and lawyers put estimated values and timing on their cases. Now, again, it depends on the kind of practice you have. If you have a high volume, lower value motor vehicle accident practice and that's all you do, you could use historical statistical information and say your average case settles for X, your average fee is Y, and it resolves in Z number of months, whatever it may be, and apply that to your current number of cases. And you can extrapolate that out. If your case is resolved in less than a year, if you have 500 cases, and we want to see what you're going to do over the next 3 years, we could presume if you're going to continue doing what you're doing, you'll have 1,500 cases and figure out the revenue projections from there. It's also important to note what your success rate is, right? Traditional banks don't like lending money to companies with irregular cash flow. They believe it equates to an actual credit risk. But quality lawyers who work on quality cases are successful well over 95% of the time. And if that's the case with you, the listeners today, make sure you bring that to the surface. You're going to resolve over 95% of your cases successfully. Also, separate out your case costs from your fees. Case costs come out of your client's share of the settlement, not out of your law firm's revenue. So it's a minor point, but it makes a big difference in terms of your borrowing capabilities. So in terms of the strong pipeline, how do you demonstrate that? Come up with projected values, timing, how much you have out in case costs today, and how much more you're projecting to spend in case costs on your current docket over the next 3 years. That's your snapshot and the value, the revenue you're going to generate, and the case cost you're going to recoup in the next 36 months. Seth, what do you want to add?
No, look. What we've seen is that it's been over the last 10 months. What we've been noticing is that the referral firms very often have been hit hardest. The digital play has continued to work. TVs continue to work, but people that were counting on those on deal flow through referrals have definitely taken a hit comparatively. People just aren't out networking and seeing those people in the communities. So, it's been an interesting period where, thankfully being in the digital space, it's been a time when there have been so many eyeballs on there and so much opportunity. Google's had new products out there. But I'm curious to know, I'm going to throw this back at you, Ari. During this time, it has been an interesting ebb and flow where people who had consistent referral pipelines, those have been more tenuous, and people with digital has gotten stronger. Is that something you've had to sort of tweak when you're sort of figuring out what is, what the next year is going to look like?
Absolutely. And especially if a law firm is relying on one or very few referral sources. If one of those dries up, that will have a drastic impact on the future revenue of the firm. So we do take that into account. The follow-up question was, how is the firm acquiring new cases? And do you, I guess the lender, look at their advertising budget? We do. We look at firms all the time. And if they're, not profiting a great deal, but we see a very large advertising budget, then we know that was a deliberate decision. Like you said, Seth, they're reinvesting back into the firm for the future growth. Hopefully that's demonstrated with a robust case inventory. Excellent. There's another question here. Did I hear correctly that the typical cost of financing case costs in a line of credit is in the neighborhood of 12%? It depends who you go to. With Esquire Bank, it's lower. No, it's a single digit bank interest rate. But not everyone could obtain their case cost financing from a bank. There are specialty finance companies out there that are excellent, but they'll charge something in the teens, but probably closer to 18.
I think that's what the person heard. When I said that, I wasn't saying that you charged 12%. I was saying there was a delta between what a bank charges and what somebody, when you leave the banking world, that's going to lend that's outside of that. And I think that's what you're just referring to.
Great. One came in, another one back to the taxes. Brian, I just want to get your thoughts on this. Maybe it's just a general statement. Best ways to save on taxes, tax planning strategies to minimize taxes owed on large settlement payouts.
We've gone through some of this stuff already, where we're talking about retiring and structuring and so on and so forth. But, like we said, is that I would like to encourage my clients to, and your listeners here, to spend on themselves, set up the future so that it's easier than it is today. Investing in a side business, as Seth knows how great that can be, is a great alternative. There could be cross-marketing techniques. There could be different tax rules in different industries. There's duplication of staff.
And we just saw that over the last 4 years.
If you open up
under Trump, the tax, speak to this for a moment. If anybody with a non-law firm, significant benefits having a non-law firm business.
Great.
Absolutely. The other thing is, residency is an issue now for people who are in a certain state, a high tax state, and they may want to retire into a low tax state, maybe set up a business in a different state so you can establish some residency issues later on so that it can pull you to that state and not have those higher state tax issues. A different tax ID number also means possibility for more deductions. For some firms who may be smaller in size, make sure that all your business-related expenses are paid through the business itself and not paid personally. Car, insurance, cell, travel, education. Meals is a huge area right now with the tax law change. And what had happened under the Trump administration, the rules were that meals, entertainment was no longer deductible, but business meals were still 50% deductible. But anybody that you do business with could generate business, could help your business in any way, shape, or form would be considered business meals and deductible 50%. Now they changed it starting January 1st of 2021 and through December 31st of 2022, that business meals are 100% deductible so long as it's from a restaurant, to support the restaurant industry is struggling, obviously.
What about
So
entertainment, like
these,
season tickets? Are we seeing any change to that? That was one of those harsh realities for my Caps
I
tickets.
don't see that coming back. I think that sometimes when you have some president or Congress and they make a tax law change like this and they take the brunt of all the backlash, it's hard to see something like that coming back, even though, all of us and our clients and so on and so forth use that legitimately for business. It's hard to see that one coming back.
We're coming up on the hour. I want to get to the last two questions. Someone asked about the different ethics opinions. So geography, again, also comes into play when lawyers are contemplating financing their disbursements. While most states expressly allow this, there are some slight differences in the language that must be included in the state-specific retainer agreement. So here's a polling question that addresses that. If anyone is interested, please answer in the affirmative. And a question just came in: is advertising 100% tax deductible?
The answer is yes. Advertising is 100% tax deductible for sure. It doesn't matter if it benefits you for the current day or sometime in the future. It's absolutely a deductible expense. It is not a case disbursement, non-recoverable, and it is definitely a deductible expense.
And we see that a lot. A lot of Blue Shark clients, prepay in December for the first quarter, 6 months, or even a year, just to be able to get some expense on the books.
Right. That's a different point, is that, all these contingency law firms should be all cash basis reporting. So therefore, if you write a big check in December to prepay whatever it is, 1 month, 2 months, 12 months worth of service, then that check would be, that advertising spend for the next 12 months would be deductible in the current day, even though service will be rendered over the next, let's say, multiple months.
A lot of talk I'm hearing in chatter about succession plans and how so many firms do not have them in place. And I know, Brian, you and I were talking about valuing law firms and how that comes into play with buy-sell agreements, estate planning, and succession planning. Maybe you could touch on that before we wrap it up.
Sure. Yeah, I think that lawyers become their own, victim of their own experience and so on and so forth. They are very much afraid to have buy-sell agreements, to have partnership agreements, to do any estate planning. It's morbid conversations, and nobody wants to have the ink dry on a specific way of treating things. But certainly planning and setting up for the future is an important thing to do at all times. And now certainly looking at your estate planning and succession planning now, while things are changing and all these tax law changes are existing, there's no time but the present.
Okay, I guess one last one, I promise. Brian, for you, if a lawyer is considering hiring associates with everything that we just discussed and they want to incentivize them, what's the best way to do that? What would your advice be there?
I love this model, but I have a very hard time to bring it into play. But the model of having them their own sort of P&L, their own profit and loss statement. How much money was brought in for that associate? How much money of cases did they generate themselves? How much money in cases did they participate on? And allocating expenses, to that specific associate, their salary, their benefits, an allocation of the overhead to that person, and show them what like a mini or a sub law firm would look like. And maybe that could be the incentive plan so that, you can really push your associates to sort of pull the bull, to take the bull by the horns and really grow their own peanut butter and jelly sandwich, so to speak. It's a different way of looking at things. And like I said, I haven't had a ton of success getting these things done, but I really would love to see that, come into play a little bit more.
Seth, I see you shaking your head. It seems like you're in agreement with Brian, and I know your entrepreneurial wheels are spinning there. But we're over the hour, and I just want to be respectful to everyone's time. I want to thank you, Seth Price and Brian Koshers, and for everybody who joined us today. We really appreciate your participation, your questions. These are important topics to discuss. Things are changing. There is uncertainty, but together we could not just survive, we could thrive. So I want to wish everybody only the best. Stay healthy, and we'll see you next time.